I welcome on my channel, theme of release. The perfect explosion of the price development of gold. Move on. Concern over the human and economic costs of coronavirus continues to stimulate the need for strategic diversification and demand for non-hazardous storage. Procyclical commodities such as oil and copper, meanwhile, saw that their recent recovery has been shaken in the face of new concerns over the expansion of coronavirus infection outside of China. The main source of influence of commodity markets is still a large amount of information about the COVID-19 virus and, therefore, the likely danger of its subsequent expansion in Asia and beyond. China, already shaken by economic and human pressure, is struggling to return to numbers. The trial recovery of prices for key commodities such as copper and oil over the past few weeks has been prompted, among other things, by the assertion that the economic effect will be mainly in the first quarter. As coronavirus continues to spread outside of China, this narrative has prompted new fears that the virus will have a lasting and negative impact on the global economy. Goldman believes that missed working days in China may also be sufficient for the entire U.S. workforce to take a 2-month unplanned break. The sheer scale of this violation is beginning to be felt not only in China, but also in other countries, increasing the risk of further short-term and medium-term pressure on commodity-dependent commodities before demand ultimately returns to higher prices. When looking at the cost indicators for the main commodities, it is clear that the markets connected to Chinese demand suffered from the most important failures. Those with tight supply chains, such as palladium and cocoa, are protected from tornadoes, while the demand for safe vaults continues to stimulate high demand, especially for gold. The almost perfect explosion of the price development of gold continues. Most importantly, these last few weeks have shown the yellow metal's ability to succeed in higher positions. Gold continues its impressive race last week because it hit a new 7-year high after the most important weekly gain in 6 months. As already mentioned, the recent expansion was especially impressive at a time when the dollar was breaking up against several major currencies. So why is gold in demand when US stocks still record highs and the dollar continues to rise? We believe that the combination of additional rate cuts, increased incentives, negative real yields in the United States that reached a 7-year low of 0.15% and increased concerns about future earnings for companies will still stimulate strategic diversification and demand for non-hazardous storage facilities. In addition, there is currently a clear risk that an outbreak of coronavirus can have longer and deeper effects. January was a very troubling month for markets with tensions between the US and Iran, followed by an outbreak of the virus. During January, the aggregate stocks in ETFs secured by ingots grew by an average of 1.3 tons per day. So far in February this year, stocks, despite the aforementioned dollar strength and stock market recovery, have grown by 1.9 tons per day. While Goldman Sachs sees gold moving to $1,750 an ounce, Citi Bank said it could reach $2,000 an ounce over the next 12 to 24 months. Reaching our 2020 target of $1,625 an ounce, the outbreak of the coronavirus is likely to send it higher, because it is difficult to determine what can stop the mover at this stage, possibly in addition to its own success, which led to a short-term overbought market. As stated earlier, commodities offer a much better understanding than stocks when it comes to the important effects of a coronavirus outbreak. Not least, given that the epicenter is located in China, the world's most dominant consumer of raw materials. Based on this, we remain concerned that the full impact on other markets from the slowdown in China and abroad is not being properly assessed. The stock exchange has rebounded strongly as investors become increasingly resilient to obvious risks. Instead, they specialize in support from low inflation, low interest rates and central banks, led by the U.S. Federal Reserve, which continue to pump liquidity into the market. Sign up for links and receive dividends. More information on the address itself on the screen.